the famous words of Ron Burgundy, well, that escalated quickly. And if you're not familiar with that reference, I apologize from as my wife would say, a stupid movie. But anyway, last week was rough. If you were paying attention, you probably had a little indigestion watching the markets. It was a doozy. Over the course of Thursday, Friday, markets dropped about 10%. So it got ugly, and it was on the heels of the tariff announcements on Wednesday in kind of some anticipation leading up. Market actually rallied in the first part of the week, but when we got wind of the reciprocal tariffs and the White House announcements, really sent the markets down kind of in a tailspin. So I understand this is not fun. If you are invested in the markets right now, not a particularly fun time to look at your accounts and see red. So recognizing that, I would just say, if you've got a long-term investment plan in place, financial plan in place, which I hope you do, please don't let a short-term move like this derail those long-term plans. I've written about this pretty extensively in my blog. I'll put a link to the blog down below in the description, and you can read as much as you want there. I've talked a lot about tariffs this year. Even in the last few days, I've written 2 blogs on the tariff situation and in weathering the storm and staying invested. Market moves like this can be very concerning, obviously, and can lead any rational person to think, man, I've got to do something here. This time may be different, and what if the markets don't recover? I can assure you they will recover, and it's never different. The situations around what's occurring in the market at the time, of course, can be different and usually are. But the way the market works and the way the market will recover from this over time, regardless of the situation, it never changes. The market will digest this, and we will come out of this on the other side. I have no idea the timing around that. This could just be a correction and a blip. Whether this leads to something bigger in a bear market, I don't know. What I do know is it's impossible to time, and markets can turn on a dime very swiftly without warning, and they will. And so just when you think you got it figured out and you're pretty sure you need to make a move based on what's occurred recently, the market has a tendency to make you pay for that. So I've seen it time and time again. I would just encourage you to try to tune out the noise the best you can, and stay put, stay convicted in your strategy. You put it in place for a reason, and don't let these short-term gyrations derail what could be a great long-term financial plan. Because once you make a move like that and you get caught in the timing game, it's very difficult to put the toothpaste back in the tube. So don't panic, stay invested. We're not concerned about it long-term at all. This is going to be fine. But I just want to reiterate that fact that, staying invested and staying the course is really the best move in a situation like this. Okay, so that being said, let's look back on last week. Of course, this is your Market in Minutes report. Looking back on last week, I'm Mike Minter, Chief Investment Officer with Financial Synergies Wealth Advisors. And let's look at the numbers behind this bloodbath last week. I'm not going to sugarcoat it. It was bad. Across the board, you see just really bad numbers for a week. Nasdaq lost 10%, the clear winner here in terms of the race down. Unfortunately, big tech continues to get hit harder than most other sectors within the indices. Valuations have gotten pretty stretched there, so it's natural to see those get hit the hardest. Let's take a look at how this has now impacted year-to-date performance. Of course, those numbers have gotten pretty ugly as well. No surprise there. I think, Nasdaq again being the hardest hit, down over 19%. I've written about this too. The valuations, particularly in the tech sector, had gotten pretty stretched. So this was bound to happen. Tariffs were the catalyst that really kind of sent this down in a tailspin. But the reality is that tech had really fallen off well before last week. We'd seen quite a rotation out of tech and into other sectors, value sectors, if you will, banking, things like that, energy, things like that, that had been pretty beaten down over the last, well, not beaten down, but just relatively speaking, had underperformed. And those things are doing better, relatively speaking, now. So this rotation had already been set in place. This was just the catalyst of the tariffs. Just kind of continued that trajectory down. But one bright spot, and just in general, diversification is working. You've got things other than your large cap domestic stocks, tech stocks doing well. You have international stocks actually in positive territory for the year. At one point, international stocks were up in the double digits, 12, 13, 14%. Of course, they've taken a hit too, like everything else, but still a relative bright spot in a diversified portfolio if you hold internationals. Bonds as well. I don't have that on here, but bonds have actually held up very well in this environment. So rates continue to come down. Bond prices are going up. Actually, let me bring those up as we speak. I would call this a silver lining. Rates are coming down across the board. So the 30 years come down, 10-year, 2-year, 30-year mortgage is now down below 6.7. This is definitely a bright spot for the housing market. So that has been a nice byproduct of the pullback. And those rates were coming down even before last week. So again, it's been nice to see that. So of course, under pressure last week, all markets, stocks did rally for the first half of the week as markets tried to anticipate the potential impact of tariffs that had been previously announced by the White House. But soon after the closing bell on Wednesday, President Trump's new reciprocal tariffs surprised the markets. And this is when you really started to see things deteriorate. So global markets reacted to the news overnight. Markets opened lower on Thursday, as we know, and the selling continued through Friday. So Treasuries rallied in a flight to quality as investors moved to the sidelines. This is where, bond prices have been driven up and rates are coming down as investors have been taking that flight to quality, as they say. So the yield on the 10-year Treasury note closed Friday at 4%. And of course, bond yields generally fall when bond prices rise, that inverse relationship. Powell's speech. So Fed Chair Jerome Powell gave a previously scheduled and very much anticipated speech on Friday. He explained the following: the labor market is in good shape and not a significant source of inflation. Longer-term inflation expectations are well anchored and consistent with our 2% inflation goal, despite higher expectations despite higher expectations for inflation over the short term. Regarding consumer sentiment, while consumers may not feel great about the economy now, they still keep spending, so that's good news. He added that the same happened during the pandemic, which really helped during the recovery process of 2020. The Fed's policy stance is well positioned to wait for greater clarity on the likely effects of trade and fiscal policy, for example, before considering any changes in monetary policy. So let's take a look at what's on deck for the week. We've got some key economic data over here. So Monday, consumer credit. Tuesday, NFIB, small business optimism index and treasury buybacks. Wednesday, we have FOMC minutes will be released. We'll keep a close eye on that. 10-year treasury note auction and wholesale inventories. And Thursday, we have the consumer price index, jobless claims, monthly federal budget, and we have some Fed members speaking. That'll be a big day. Friday, we have the producer price index, consumer sentiment, and we have New York Fed President John Williams speaks. Not much going on in the reporting season yet. That will ramp up over the next few weeks, but really just Friday, we have JP Morgan, Wells Fargo, Progressive, BlackRock, and Bank of New York. So some financials reporting on Friday. So that rounds out the week. Folks, hang in there. I know it's a tumultuous period in the markets. If you ever need to get in contact with us, whether you're a client or not, please do so. Here's all our contact information for you here. And hit that subscribe button down below if you haven't already. We'd love to have you get all our YouTube videos as they come out. And with that, I will leave you with some light disclosure, and we will talk next week. Thanks, guys. Have a good one.